to successful living. Last year, there was lots of talk about different tax changes. Many may have not gone through, but there were a lot of actions that happened. And to join us today is our tax expert, Greg Porcaro. Greg, thanks for joining us today. Good to see you.
Good to see you. We were hoping to do this live in person.
Yeah.
I guess maybe next time, huh?
Yeah, a little hiccup, but I think we'll be back shortly. So before we even get started, I'm just wondering, at this point of the year, in your business, what do you see? Are people already coming to you before they have forms? What's happening right now? Let's call it the third week in January.
So, from our business clients with that, we're seeing a little more interest in getting things rolling a little quicker.
Yeah.
Individuals are still going to be waiting for documentation, so we really haven't seen much. Many people start calling for either appointments or an opportunity to drop off, in December. We were bracing for a much worse season, had they passed last minute legislation that caused disruption to the IRS and us. This could have been much worse. I mean, it's going to be difficult as it is, according to the IRS. That they're anticipating a tough year for themselves due to staffing shortages, et cetera. So it's going to be an interesting period, but it could have been much worse.
Yeah, great. All right, well, let's get started. So we talked about last year's child tax credit, and that payments sometimes were paid in advance. Can you tell us about the impacts that may have on taxpayers in 2021 for their returns?
Yeah, it's really important that we talk about this, because we're embracing for this to be a problem for us, helping clients prepare their tax returns. So as you know, the credit was increased for children significantly, $3,000 for kids between 6 and 17, a child under 6, $3,600. So not only was the credit increased, it was sent out in advance. So you'd get a monthly check depending on how many kids you had. And I've talked to plenty of people who found that to be very helpful for them. It was a brand new process for this. Some people were able to opt out if they were afraid their income would exceed the thresholds, which for a married couple is $400,000. So a lot of people are eligible for the credit. But they're basing the credit on estimated information. So if they were looking at someone's 2020 return, that might have been an off year, they might have made less, and 21, they might make more, so it has to be reconciled. You're eligible for the credit based on your 2021 income, so it's either gonna be higher or lower, depending on how much you actually received and whether you had opted out or not.
Okay, if you did, let's say, get it, like have an overpayment too much, how do you rectify that and how do you change that?
So what viewers have to be on the lookout for is a brand new form, 6419.
All right, I think you sent that
really
to me.
Important.
We'll pull that up. Is that helpful to pull up right now?
I think it would be, so they'll know it actually came from the government, because it's brand new. They would have never seen it before.
Yeah, and you had mentioned last year there was a form that was sent out that really didn't look very valid, but it really was. And I think this was one of your points to make sure people take a good look at this, because when they receive it, it is a valid form that they need.
Right, we're definitely going to need that to reconcile what they received in credits versus what they were eligible for. And to the extent they didn't get everything they were supposed to get, they'll get the difference when they file their 21 tax return. On the other hand, if it turns out they received more than they were supposed to, well, then they'll have to pay that back, which is why we suggested to people to opt out, because no one likes paying stuff back. No one ever minds getting a little bit extra. So the form is really important, because the stimulus documentation that really created difficulty for last filing season, I've seen some of the examples of the letters didn't look real. Like they were like,
yeah,
it looked like a letter instead of a form. So if you want to bring that form up, so viewers could see what they should be looking for.
Yeah, we just brought that up as you were talking through it, so I think they got. Do you want us to bring it up again, or you don't need to really point it out?
No, from my side, I couldn't see that.
Yeah,
so I guess it's one of the dilemmas of this side of this type of technology. Anyway, so it's really important for viewers to find the form, make sure that they bring it to their CPA, so they'll be able to verify what was received.
All right, what
if they didn't get it?
Yeah, or what if they misplaced the form, right? So they don't get it, or they threw it out because they said, "Oh my God, like what do they do next?"
So that's more likely than not to happen, right? Not everyone's going to keep this form. And so the next step is you have to set up an account at irs.gov. So now the Internal Revenue Service has, and we've talked about this before, you can set up an account with the IRS, so you can go in and see what they see in terms of estimated payments, stimulus payments, and even this advanced child tax credit payment. So if you don't have the form, it's really a good idea to go in and verify this, because if we don't get any information, it's very likely the return we prepared might be wrong. And the IRS is not obligated to fix it if it's in your favor. So we want to be proactive. We want to get the information from our clients to say, all right, here's what you received. reconcile it on the return, and make sure the return is done correctly.
Okay. Anything else you'd like to add on the child tax credit? Any information? Or
But more or less a warning, right? The IRS has already indicated, make sure you get verification or it will hold up the processing of your tax return even further, given their anticipated delays. So if you're expecting a refund and you'd like to get it before Christmas, let's be proactive and get that information as quickly as possible to your tax preparer or CPA.
Okay. Let's move on to the stimulus that some people received last year. And how should they, in a sense, handle that on their tax return?
So this is a very similar problem, right? So people were receiving stimulus payments. The third version came out in 21 based on prior period returns. There's a reconciliation. There's a form now that they improved the form. I wasn't able to find a copy of it, but it's a 6475 form that will tell you what you received as stimulus payments, which we have to use to reconcile on your tax return. I can tell you last year, many clients had no idea what they received. Some had received letters that indicated an amount that wasn't correct. So many were trying to set up an account with the IRS, which is not a simple process. They do extraordinary measures to protect people's identity. So it's not easy to do. And so we filed returns with best guesses. And unfortunately, the stimulus payment, they will fix, they will reconcile. Some people owed more than they thought, and some people didn't get as the refund they expected. Some people got more money than they thought. No one likes surprises when it comes to taxes, so we prefer to have the most accurate information available. So try to determine what the payment was that you received as part of the last stimulus, COVID stimulus related payment, so we can avoid any complication with the Internal Revenue Service.
Okay. Let's shift gears a little bit to the self-employed taxpayer and talk a little bit about maybe the changes, or, I know one of them were meals and deductions. If you can talk a little bit about that so people are aware of it.
So part of, and I don't recall exactly what piece of legislation this came out of, but previously business meals were only 50% deductible. So we'll talk about what a business meal is in a second. For 2021 and 2022, that threshold for meals paid for in a restaurant, and I have to say that for a reason, 100% deductibility. So it's a really big deal for people in business who are incurring this expense for a legitimate business reason, because now they're getting a much larger deduction than they were getting previously. And it's really a big change. It's only around for 2 years, however, and it was intended to help stimulate the restaurant industry as a, with post-COVID, reaction. People maybe be more inclined to have dinner. It kind of maybe doesn't make sense that you'd risk potentially your health just to get an extra meal deduction.
So my $20 lunch that I pay for myself, if I were to qualify
that doesn't count.
Business, right? No, I know it does. Okay, good there, but
unless you talk to yourself, and then maybe
well, that happens quite a bit. Yeah,
that's happened to me too. So the meal has to be business related. So the key is that you have to be able to document who you were with. Primarily, there's 5 things, but the 2 most important things are who you're with and why you're with them, and what business was either conducted or in pursuit of business. So business meals take a pretty broad path in terms of what's potentially deductible. So you want to keep good documentation as to who you were with, why you were with them, in the event you had to prove to the IRS that the meal was actually incurred for a business purpose. There are a lot of other quirky rules, but that's the key. And the other thing I just want to emphasize is the expansion was focused on restaurants. So the change was for meals in restaurants. Now, I've been told or read that also includes stuff that you order from restaurants that's delivered, whether it's
that makes sense. Yeah.
So, but it's not intended for people that pick up food and bring it to the office, even if it's for their staff or something like that. Now, it's a weird distinction.
Yeah.
So if you go to Dave's and get a pizza, for example, and you bring it to the office, it's not the same as calling Domino's for a pizza. Yeah. So it's an interesting thing that most people wouldn't even think was an issue, right? It's kind of odd. And I don't know how material it'll be in the big picture, but it's something to be aware of.
Tell us a little bit about, like if you purchase a new car and you own a business, how is that deductible? I mean, I've heard it all the way down till you can, depreciate it as much as you can in the first year, or you can depreciate all of it. I've heard things across the board. How does that work?
So it's interesting. This could be one of the most common questions that I get. And in fact, I was just speaking with a client earlier this morning about this very question, and it comes up so often. And the first and foremost, you want to remember that, yes, there are business deductions for the business use of vehicles. And I'll talk about a little bit more about that. but you can't let that drive the bus, so to speak, right? So you can't go out and spend a ton of money on a car just because you might get a tax deduction for even potentially all of it at the extreme, because you're still out of pocket. And as an investment advisor, financial advisor, spending $100,000 on a car might be crazy. And even if you get a deduction for it, at the highest tax bracket, you save 40% maybe on average, right? You're still out the 100,000. So I try to tell clients, be practical about their decisions about vehicles. Try to buy maybe one a year old or something left over. Now, this is a weird market, as you know, because car prices are through the roof and it's even hard to find vehicles. The bottom line is documentation, business use. So it's going to be well documented, and that everybody has the discipline. I met with someone this week who has an app on her phone that tracks where she is, so that's great. Certainly be acceptable as documentation. So the bottom line is this: for a business, a vehicle that I'm going to use the extreme, 100% for business almost never happens, right? Because there's always some degree of commuting. In most cases, you can book today for 2021 and 2022. You can write off, if it's an SUV over 6,000 pounds, 100% of the vehicle, assuming it's 100% business. Right? So that's an extreme example we don't see. If it's less than 50% use, that doesn't apply. Then you have to use the regular depreciation rules, which basically spread out the deductibility of the car over a longer period of time than 5 years based on business use. So if the typical scenario would be, let's say a real estate agent might be on the road 80% of the time, legitimately, right? So 80% of their vehicle expenses would be deductible, assuming they keep good records. And that means that vehicle we either can write off almost all at once if it's an SUV over 6,000 pounds, 80% of the cost, or a staggered amount. I think it's 18,000 for the first year, and then it goes down, from there.
I don't want to cut you short. We are running out of time. I know it goes fast, and I want to know more about that, but I think obviously you need to talk to your accountant as you go through that. So
absolutely.
As always, thank you very much for all the great information, and we look forward to seeing you soon, Greg. Thanks.
Thank you. Take care.